You don't need to be a stock picker to win at investing. You can grow money steadily by buying something simple, broad, and patient, the S&P 500, with a plan you actually follow. This video is about a beginner-friendly way to invest in the S&P 500. It's part of a series called Explained, and yes, this is edition 126. We'll keep it practical, with steps you can start today and a routine you can stick to. First, what is the S&P 500 anyway? It's a collection of 500 large U.S. companies. The index is broad, covering tech, healthcare, finance, energy, and consumer goods. When the whole economy grows, the index tends to grow too. When it shrinks, it tends to shrink as well. The point for beginners isn't to predict every move. It's to own a piece of the market's long-term growth and let time do most of the work. Let's get into a simple, repeatable plan. It won't require you to time the market, chase hot tips, or read hundreds of pages of financial theory. It's about consistency, low costs, and a clear routine you can follow month after month. Step 1 is to set your goals and knows your risk. Decide what you're saving for and when you might need the money. A basic rule is to balance ambition with safety. If you're in your 20s or 30s, you can usually tolerate more risk because you have time to recover. If you're closer to needing the money, you'll want a more cautious approach. The idea is to pick a number you can live with, emotionally and financially, every month. Step 2 is choosing where to put your money. A regular brokerage account works, but many people benefit from tax-advantaged accounts like IRAs or 401ks. If you have an employer plan, you might want to contribute enough to get any match. If you're starting fresh, a simple taxable account works too. The key is clarity. You want one place where your S&P 500 investment lives, not a dozen places that complicate things. Step 3 is picking the fund. Look for a low-cost S&P 500 index fund or ETF. Popular choices include funds with very small expense ratios. Why care about cost? Fees eat into your returns over time. A difference of a few tenths of a percent each year compounds into big gaps after a decade or two. Choose a fund with broad exposure to the 500 companies and a long track record. You don't need a fancy name, you need a low price and broad coverage. Step 4 is automating your plan. Set up a monthly automatic transfer from your checking to your investing account. The amount can be small at first, but the habit matters more than the size. The automation makes you invest even on busy days and even when you feel uncertain about the markets. It removes the emotional part of investing. Step 5 is dollar cost averaging in practice. Every month you buy the same fund, no matter what the market does. When prices are high, you buy fewer shares. When prices are low, you buy more. Over years, this smooths out the buying price. You don't need to forecast the best time to buy. You just commit to a schedule and stay with it. Let's give a concrete example to make this real. Suppose you set aside $100 a month. If the market returns about 7% per year on average, and you keep investing for 30 years, your money grows through a combination of earnings and new contributions. The math isn't perfect, but the idea is simple. Compounding works when you keep adding money and let the market do its job over time. After 30 years, $100 a month could look like a sizable sum, roughly around 6 figures depending on the actual returns and any tax effects. If you start with $200 a month, the total grows roughly to the double. If you start smaller, you still gain a lot in the long run by staying consistent. Step 6 is to think about your allocation. For beginners, a straightforward rule is to place most of your risk-capable money into the S&P 500 fund and keep a smaller portion in safer assets. A common starting point is something like 70% to 90% in the S&P 500, with the rest in a short-term bond fund or a cash reserve. You don't need to overthink this at first. The aim is to own a big slice of the market's growth without taking on too much daily risk. You can adjust as you learn what you're comfortable with. Step 7 is about rebalancing. Markets move, and your balance can drift. A simple approach is to rebalance once a year. If your stock portion grows, you'll end up with more than your target. If it shrinks, you'll have less. Rebalancing means selling some of the areas that have grown and buying more of the areas that have not. It keeps your risk profile aligned with your plan. You don't need to do it every month. A yearly check is enough for most beginners. Step 8 is about cost and taxes. Use an account that aligns with your goals and tax situation. Look for funds with low expense ratios and no heavy trading fees. If you're in a taxable account, you'll want to consider tax efficiency and when you sell. In many cases, long-term holding of the fund is more tax efficient than frequent trading. Use tax-advantaged accounts when possible, especially for long-term growth. Step 9 is about avoiding common mistakes. Don't chase the latest hot fund or try to time the market. Don't invest money you'll need soon. Don't pay high fees or trade too often, which can eat away returns. And don't overcomplicate the plan with too many moving parts. A simple, repeatable routine beats a complex, constantly changing one. Let's talk about a simple weekly or monthly ritual you can build. Start by reviewing your plan quickly once a month. Check your automatic contribution is running and your chosen fund is the same. Look at your overall goals and remind yourself why you started. If you notice fear or excitement taking over, pause and breathe. The plan is designed to work over years, not days. Now, a practical, beginner-friendly week-by-week setup. Pick a fund with a low expense ratio and broad coverage of the S&P 500. Open or use an existing brokerage account. Set up an automatic monthly transfer on payday. Choose an amount you can miss without feeling a pinch. For example, if you earn enough to cover essentials and still have some left, start with $25 to $50 a month and scale up when you can. Automate your monthly investment at the same time every month, so it becomes a fixed habit. Next, decide on a starting allocation. If you're comfortable with more risk and you have time, you could start with 90% in the S&P 500 fund and 10% in a short-term bond fund or cash. If you want less risk, start with 70% in the S&P 500 and 30% in bonds or cash. You can adjust as your situation changes or as you learn more. The key is to keep it simple and consistent. A quick note on patience. The market will have good months and bad months. You don't have to celebrate every gain or agonize over every drop. The plan is designed to ride out the waves. Time in the market tends to beat timing the market. That's the core idea behind this approach to beginner investing in the S&P 500. If you're worried about doing this alone, you're not alone. Look for a learning pace that fits you. Read one short guide or watch one video a week. Keep the habit small and sustainable. Small steps, repeated over many years, create real progress. You don't have to be perfect. You have to be steady. A simple long-term projection can help you stay motivated. If you start with a modest monthly amount and keep going, you'll see the effect of compounding over time. The exact numbers will vary, but the principle stays the same. Regular investing, low costs, time, and patience together can create meaningful growth. You'll notice that your awareness of your money grows with the routine, not just the amount. To summarize the actionable strategy in plain steps, you can follow this week. Decide on a goal and the amount you can invest monthly without sacrificing essentials. Choose a low-cost S&P 500 fund or ETF and open or use an existing account. Set up automatic monthly contributions on payday. Pick a simple allocation, for example, 80% to the S&P 500 and 20% to a short-term bond fund or cash reserve. Commit to rebalancing once a year and review your plan briefly every month. Keep costs low and avoid high trading or chasing hot tips. This approach isn't about getting rich fast. It's about building wealth gradually with a plan you can keep. The S&P 500 is a long-term engine that rewards discipline more than prediction. The smarter move is to start small, stay consistent, and let time do the heavy lifting. If you're ready to begin, start today with the easiest step you can take. Pick a trustworthy, low-cost S&P 500 fund, set up the account if you don't have one, and arrange an automatic monthly transfer. Even a tiny amount every month compounds into real results over years. The key is to begin and keep going. Finally, remember, this is a beginner-friendly approach. It's meant to feel doable, not intimidating. You don't need insider knowledge or a high bankroll. You need a simple plan, a steady routine, and the willingness to let time work for you. If you found this video helpful, please hit like and subscribe. I'll keep sharing practical, calm strategies for growing money without the hype. And in the comments, tell me what part of beginner investing you want explained next, or share your first step you're going to take this week. Your feedback helps me shape the next videos. Thanks for watching, and I'll see you in the next one.